Good morning. My name is Ragavan, and I would like to warmly welcome you to today's discussion on a topic that's very close to my heart, ESG, and how it impacts investment decisions. First, a bit about me. I'm a corporate partner specializing in M&A. I have a particular interest in private equity and act for a number of family offices on buy-side mandates. I also act on sell-side mandates for owner-managed businesses, walking them through that very tricky exit process, and also assisting management teams. Indeed, I chair the firm's private equity audience group. So essentially, I love everything to do with M&A and private equity. My co-chair for today's discussion is Janine Alexander, a partner in our dispute resolution department. She specializes in making the contentious non-contentious, a great strapline if I've ever heard one. The sad truth of it is that I live for buying, selling, and investing into companies. So this really is a topic that's very, very close to my heart, as I do feel assessing ESG metrics is an important way of understanding the strength of an opportunity. As such, I would like to thank my guest speakers, Adrian, Adam, Jen, and Lucy in advance, because I'm sure they have interesting perspectives given their different experiences grappling with this increasingly important topic. Before I get to the talk though, I thought just in case this is your first contact with Collyer Bristow, I'd give you a bit of background about the firm. Collyer Bristow is a full service law firm. So our practice covers corporate and commercial, employment, property, commercial disputes, intellectual property, and all private client services. So tax and estate planning, for example, and also family law. We pride ourselves in actively listening to our clients and delivering great results. In terms of admin for the discussion, the more astute amongst you would have noticed there's a box for you to type in your questions. So please do avail yourself of that opportunity, and the panel and I will seek to look at some of those questions at the end. In connection with this talk, Collyer Bristow commissioned a YouGov survey. And the first question was, how important, if at all, are the ESG credentials of a company when you're considering making an investment decision? So hopefully if the technology is working, and it is, the question should have flashed up on all your screens. And in a bit of a who wants to be a millionaire moment, I'll give you a second to vote on the question. Great. Yes, well, some of you got this right. So Adrian, if I may, can I ask you to introduce yourself, and then can you give your take on this question?
Yes, thanks, Ragavan. My name is Adrian Field. I have a background in technology and innovation before getting into finance and investing in 2005. I have worked for a number of venture capital and private equity funds before joining family offices more recently, and currently work at Perscitus LLP, which is a single family office, which has a fairly active strategy in direct investments. In terms of assessing ESG in the decision-making process, investment-making process, I think it's important from my perspective anyway, to point out the wide array of aspects to ESG. A lot of people talk about sustainability, which is slightly different to CSR and some of the PLCs that have policies and practices around CSR, versus ESG, versus something like a B Corp, which is quite a new structure, which is again slightly different again. And I think all of them, you can think of it as 50 shades of gray if you like, but there's no single clear standard, which means that in investment decision making you need to really go into the details to understand what is the company actually doing, what are their practices, and the way I like to see it is, what are they measuring and how is that changing over time? So it could be anything from how much paper did they use last year to how much paper they're going to use this year, and understanding those aspects are actually critical to understanding the wider ESG impact, if you like.
Yeah, so it's about actually drilling down into what ESG actually means and also then determining the metrics that you can actually benchmark against in terms of performance. Yeah, that's a kind of interesting point. It's no point just bandying a buzzword around with actually understanding how it tracks through to performance. It interesting you mentioned about B Corp and kind of certain benchmarks that are becoming more prevalent in this kind of ecosystem. I don't know, Adam, if I could perhaps throw to you for a bit. Do you mind just briefly introducing yourself? Because I know you have a particular interest in B Corp potentially.
Absolutely, we do. Thank you, Ragavan, and thank you, Lucy, Janine, for the invitation and opportunity to sit on this panel. So I'm Adam Spencer. I'm a corporate finance advisor at Tamweel Capital. Tamweel are an M&A advisory boutique. We're focused on providing advice and support to shareholders of challenger brands in the consumer sector. Typically, we're working with small to mid-cap companies, largely on the sell side, and also fundraising roles for growth businesses. Previously, I spent 10 years in RSM's mid-market M&A and private equity team in London. And most of what we do involves interaction with institutional investors in one form or another. Either we're working with private equity-backed businesses on the sell side, or we're raising a first round of institutional growth capital for founder-led businesses. Most recently, we've been working in deals across leisure, hospitality, wellness, and consumer products. On the topic of B Corp, and for those that don't know, B Corp is a third-party certification or accreditation that recognises businesses that meet high standards of social and environmental performance. We're actually partway through the process of becoming a B Corp ourselves. I think hopefully we'll be one of the first advisors out there to become B Corp accredited. So it's something we're really excited about, but the process is very laborious, very thorough, but actually quite cleansing and enlightening. It's allowed us to really look at our business in a different light. It's relatively easy for us because we're a smaller business. There are a handful of people in our team, and so going through that process is a little bit easier than if you're a business with long held and established processes and practices that need to be adapted in order to fit the kind of B Corp mantle. So it's ESG is a topic that's close to our hearts, and given the work that we do in the consumer sector, obviously ESG is a very hot topic in that category at the moment. And I guess what we can add to the discussion is kind of a view from the coalface. We spend our time helping our clients get ready for processes, and ultimately what we're there to do is to drive value for the shareholders in a fundraising or exit. And increasingly, and it goes back to your question, is ESG an important consideration? I noted 90% of the respondents said it was. That absolutely plays out in what we're seeing, and that's really from the way that we look at ESG is both from a kind of demand and consumer perspective, but also a supply of money perspective. So from the demand side and the consumer side, we're seeing consumer demand really turning, the momentum really turning towards people being attracted to businesses that are demonstrating strong ESG credentials, that are transparent, that are using business as a force for good. You have your so-called, I guess, eco warriors, those people who are specifically looking to buy from businesses that have where ESG is kind of a core part of their proposition. But that's still a relatively small proportion of the market. But the wider consumer base is kind of catching up. Your average consumer still wants the product to do what it says it's going to do. They still want the service that they're promised. They want it at good value. Those are kind of core. But ESG is really becoming increasingly important for those consumers as well. And retailers are also recognizing this on the topic of B Corp. Ocado and Waitrose have B Corp only aisles. But I think what's more important, what's more interesting for this discussion is around the kind of supply of money perspective and the funds being pumped into ESG and impact investing. It's just absolutely going crazy at the moment. So I think early this year, assets under management for ESG funds hit $1.7 trillion. This year, by the end of this year, it's probably going to be in excess of $2 trillion. There's just a wall of capital that's seeking impact and ESG opportunities. And it's playing out in the mid-market where we sit. So there are a number of private equity businesses that are becoming or have become B Corp themselves. So the likes of Piper are becoming B Corp, True Capital, Towerbrook, they're B Corps already. And then you're seeing the rise of impact funds. So Bridges are a fund that there were trailblazers in that space. They've been around for some time now. Palatine have raised an impact fund. A Future Business Partnership are doing really interesting things. So these are financial investors that are actively seeking businesses where purpose is the driver of profit, as opposed to just seeking your financial returns. And clearly, the more money that's seeking out those opportunities, that's only going to have an inflationary kind of impact on asset pricing. And so I think investors are coming around to the view that ESG. That I'm sure we'll come on to kind of greenwashing and diligencing ESG later on, but there's an increasing school of thought that says businesses that are doing the right thing, where their main concern is purpose and profit kind of follows, is kind of the way forward. And I think that kind of plays out in trade, when you're looking at trade exits as well. Some of the big kind of conglomerates, the acquirers, are looking to acquire businesses with very strong eco and social credentials, as that gives them a bit of a halo effect when they pull those businesses and bring those businesses on board. And so we're in the consumer sector. This has been a hot button topic for a while. It's increasingly so. You've got COP26 coming up in a couple of weeks. You can't turn the news on at the moment without hearing something about climate change. So I think it's only going to become more and more kind of top of the agenda.
Yeah, I would never describe myself as an eco warrior, particularly given the car I used to drive when I was younger. But even myself, I've looked up, made a purchase recently, and one of the things I was interested in it was in the B Corp certification. But if I could just bring in Jen at this point, because something that you mentioned, Adam, was the kind of the B Corp mantle and that kind of hurdle and that kind of you had to get over, and that kind of compliance almost checklist that you tick. Now I'm sure Jen's gonna have an interesting take on the marrying of compliance and the compliance burden with ESG. So Jen, if you don't mind, if you could introduce yourself and give us your take on ESG, and particularly, I don't think compliance and ESG is a combination that you like, I imagine.
Yes. So hi Ragavan, and thank you very much for having me. Hi everyone, my name is Jen Tan. I'm the global head of stewardship and sustainable investing at Fidelity International. We are a global institutional investor. We manage just shy of $800 billion on behalf of our clients. I should actually say that my own background is in the exciting field of professional legal services. I had the distinct pleasure of having gone to university with your co-chair, the woman who makes contentious disputes non-contentious. So that's a clear highlight in my CV that I wanted to bring out for everyone in this audience. I think when I think about ESG. So to answer your specific question, I think about ESG in terms of three layers, if you like, right? So the first layer, which is increasingly important now, is how do you, as a business, comply with minimum ESG requirements? And I think we can see regulators all around the world focusing on this as being a key issue, whether it's around disclosure or business practices or so on and so forth. But for ESG to, I think, genuinely mean something, for ESG to have the potential that I think it does, it can't just be about minimum compliance. It has to rise above that. And so the thing where I think it needs to rise to is around the genuine integration of ESG within the business strategy of the company itself. How are they thinking about it from the perspective of doing the right thing, fulfilling their corporate purpose? And then how does profit become the outcome of a company's delivery of its purpose, rather than being the purpose of a company itself? And then I think the third layer beyond that is around systems level solution. I think this is where Adam's comments, I think, were particularly correct, because the potential of ESG or sustainable investing is really in its ability to reshape private capital flows in their aggregate. And I think we're already seeing that play out in the broad capital markets and things like COP26, the focus on climate, and also I should say COP15 occurring this week in Kunming around biodiversity. These are all things that have that potential to do that. So I think the broader potential of ESG is around, can it make capital markets serve the purposes of society? Can we use this incredible powerful force we have of global capital markets and use it to channel capital towards the things that we know we need to in order to have a prosperous society and a habitable planet, to be honest. The sort of final comment that I make around my observations on ESG, I actually think in some ways the term ESG might be becoming a little not as useful anymore. It's actually too broad, and at a point when it means everything, then it stops meaning anything at all, right? So I think we kind of maybe need to think about how we kind of move past that label. Just one very basic distinction in ESG that I commonly see, that is often the source of a lot of greenwashing concerns, is the differentiation between ESG in terms of how a company runs its business. So what the EU regulators would call sustainable characteristics. So you can have, for example, a beverage company that has great water efficiency, right? Or you can have a supermarket that looks after its employees or its supply chain, and that we would call sustainable characteristics. And then you have ESG in terms of sustainable objectives. So what is the business of the model? What is the business model of the company itself? And does the business model serve a specific thing? So really the difference between how a company operates and what a company does. And these two things, while they may be interrelated, it's helpful when you come to analyze a company to think of those as being different things. I'm sure we can all think of good examples of companies that have businesses that align themselves to good sustainable objectives, but you would question mark around issues around corporate governance or around environmental safety records or so on, or vice versa. You can have businesses that operate in very traditional manufacturing, steel, cement, that are trying to do their best to operate in a sustainable way, but no one would kind of look at that business and their model and say, well, that's a sustainable business.
Yeah, that's a really interesting point, Jen. And I like to just to dial into the idea that, if the term is too broad, it kind of loses meaning. You really do need to dive into the detail, and without having that granular detail, you can't really understand the opportunity. In particular, I feel that a lot of people focus on the E in ESG, and not as much kind of weight is given to some of the other kind of issues. I don't know if I could circle back to Adrian at this point, whether he has any kind of comments to kind of reflecting back what he's heard from Adam and Jen, or you're on mute, Adrian.
Yeah, sure. I mean, I think Jen's comments are really insightful, and I think there are different layers to the onion, as it were. I think that this idea of ESG as a concept is not going to go away. This is here for the long term, whether it's under that label or another label. I mean, you can see it within the financial ecosystem. We have large pension funds which now have ESG departments and heads of ESG, and they are enforcing and imposing these sorts of best practices on the underlying funds, who are then in turn pushing that down into the companies that they invest in. And so we are going to see a spread of these sorts of activities and mindfulness, if you like. And I think Jen's comment is correct. You have a very basic layer, which is you're going to go into due diligence on a company, and you're going to look at the GDPR, you're going to look at the anti-bribery, anti-money laundering, all of these elements, which are sort of really the basics, the tick box exercise. Ragavan, as you you get into DD, you're going to look at the employee contracts, you're going to look at have they got any environmental issues, have there been any litigation, all these sorts of issues. And it's odd, because you can even take something as simple as employee churn. Now, employee churn might be high, but is that because you're treating employees badly, or is that because there's a competing factory next door who's willing to pay a little bit more? You know, it's very difficult to drill down into, you know, sometimes the cause and effect for some of these situations. And it may take, you know, a bit more effort and a bit more time to understand the ramifications. But I think, you know, this is not going away. And I find it particularly interesting. I met a hedge fund the other day whose focus is on the zero carbon outcome. So they're saying, look, we know that zero carbon is the future. We know that all businesses are driving towards that. We know regulation is driving towards that. We know consumers are driving towards that. We know that that is the point of convergence. So how do we make money? By doing the trades which are going to be affected or impacted by that convergence. And I think that's just exemplifies the fact that it is the future. It's not going away, and you know, businesses are going to have to do their best.
Yeah, it's like obviously tobacco companies moving to not selling cigarettes as a thing. That direction of travel seems to be unstoppable at the moment, and rightly so, as Jen has been mentioning. I think the deployment of capital efficiently doesn't need to be a tension between driving profits and revenue and ESG concerns. But just kind of dialing into how it impacts pricing of investment opportunities. Do you have any thoughts, kind of, Adrian, on, you know, if you look at two opportunities and they're similar, but one has better kind of both, they're both similar, so they both have the same kind of overall ESG outcome impact, but the mechanics of actually delivering their product on one side is better, that company is going to be priced at a higher price point. What do you think about the future? Is that kind of sustainable? Is there going to be, I think we're discussing it now, since it's a hot topic now, and how is that going to impact pricing issues, and whether there's going to be an overcorrection towards ESG?
I mean, if you look at the MSCI data, I mean, it shows that ESG leaders have outperformed the rest of the market, not just over the last 1 year, 2 years, but even 5 years. Is that sustainable in terms of returns? I think not. You know, I think there's as has been said earlier, there's a wall of money chasing ESG opportunities, and inevitably, as Adam said, you know, inflation pricing is going to go up on those opportunities, and I expect that, you know, in another 5 years, we're going to start to see underperformance, perhaps, by ESG funds and ESG focused funds. I don't know. That would be my prediction. You know, and that would be as a result not just of demand and money piling into it, but also perhaps as what we might get onto in a minute in greenwashing. You know, everyone's going to want to be in that ESG basket so they can benefit from incoming investment, and so you're going to get much more greenwashing. And as Jen said, it may become meaningless. We may need to look for better ways of defining and determining what we're doing.
If I could just pick up on that as well, Adrian, I think you mentioned earlier about you know, pension funds, you know, being, you know, this being an increasingly important topic for them, that kind of feeding down through the food chain into the underlying PE funds and then into the investee businesses themselves. And so I think there's kind of, aside from the pricing issue, there's probably you know, will deals get done for businesses that don't meet these kind of best practice standards? You know, legislation is one thing, that's kind of a de minimis. You know, you kind of, you know, need to be adhering to the local legislation, but you know, there are a whole raft of, you know, best practices that are being kind of, you know, either imposed on businesses, or, you know, if CEOs aren't conscious of what their competitors are doing and what investors are looking for, there's a risk of being left behind. And on the topic of pricing, I saw a McKinsey survey from a couple of years ago saying that, you know, CEOs were willing to pay a 10% premium for businesses that had positive ESG, as opposed to a business that had kind of negative ESG policies, or wasn't doing the right thing. I think, you know, if you were to recut that survey today, there wouldn't be a pricing gap. It would just be we just won't invest in businesses that don't meet these kind of, best practices, that are doing the right thing, that are heading in the right direction. And that kind of goes to Jen's point earlier about what a company's intentions are and what direction they're heading in. And I think that is where diligencing those intentions is quite difficult, because these aren't kind of ingrained into processes. You can't check that they've done them already. It's about the direction of travel, and that's kind of more about culture. It's culture at board level, but also it's culture of the employees as well. If every single employee is bought into a mission, which is to do better for the environment, to govern ourselves in the better way, to treat our suppliers fairly, to treat our customers fairly and our staff fairly, then you could probably make a pretty sensible assumption that they're not going to be cutting corners in terms of their reporting, and that what they present to you, they actually believe in and is going to be correct. Whereas if businesses don't have that kind of culture ingrained, there's a risk of manipulation of data, or positive presentation of data to show the right story, and that's where the diligence piece becomes kind of really important.
And just to kind of bring in Janine and Lucy at this point, I think we've mentioned greenwashing a couple of times. So it'd be great to hear your thoughts on, well, I think we're all in vehement agreement that ESG, and actually but drilling down to the details of those metrics is really important. If you drill down to those metrics and you, or actually if you've been told that an opportunity has great ESG credentials, what is your take on actually, once you kind of get in there, you realize the investment isn't quite as first seen?
Yeah, so this is very interesting, because Lucy and I have been discussing these issues for quite a while and thinking about them, I think, independently, even before we were discussing them with each other. So we were worrying about greenwashing before it had a name, I think is probably fair to say. It's recently been given a name, but what we could see developing was, as Adam has been mentioning, this sort of market impetus, which is meaning that people are rushing. There's lots of money looking for this, and I agree with the issue about the vague concept of ESG. What we could see was it sort of turning into a snowball, barreling down a hill, with the regulators and everyone essentially trying to catch up, everyone who hadn't got on in there early, trying to catch up. And that's a situation which, in other contexts we've seen is ripe for disputes and issues. So the regulators are, as we know, over the last few years, have been starting to catch up, are now focusing quite heavily on this. But I wanted to, I'll ask Lucy to explain sort of where we think the major areas for claims are. But I think the main issue is this issue around expectations, and whether it's clear whether anyone who is selling themselves to investors on the basis that they have ESG credentials, and we've discussed, we need to be clear what we mean by that, or is it clear what they're promising? Is it clear what they're not promising? And if there's a mismatch between what investors expect them to be doing based on what they're saying and what they're actually doing, I mean, that's where you're going to get disputes, I think, over the next few years. And we're starting to see some of them in different jurisdictions coming through. But Lucy, I'll hand over to you to just sort of set out what we think the key areas are.
Yeah, sure. So I'm Lucy Waddacall. I'm an associate at Collyer, Bristow in the disputes team with Janine. So I do sort of general commercial disputes, and I have a particular interest in this area, as Janine has just mentioned. So yeah, we see greenwashing, which I think we're all using to sort of mean where something that's a sort of green credential that's been put forward by a company or an investment is either sort of misleading or untrue, although I think we've sort of discussed that it might not go so far as being untrue. It's more sort of overemphasized or not quite living up to what the company is saying. So that's what we mean by greenwashing. And we would look at that as just a sort of a subset of misrepresentation, and it would greenwashing in that sense might give rise to a misrepresentation claim in the same way that any other kind of representation given to an investor or a shareholder might lead to a misrepresentation claim. The interesting aspect in the greenwashing sphere is that it might be more difficult for an investor or a shareholder to prove that they've lost anything as a result of relying on the misrepresentation, because in the UK you need to prove sort of financial loss in order to bring a damages claim. And I'll come back to that, but it's also worth bearing in mind that another remedy for misrepresentation, where you've relied on something that's turned out to be not true, is rescission, which means sort of unwind the contract that you've entered into as a result of the representation, and sort of, you know, unwind the investment if that's the reason that you've made the investment. So that's something to bear in mind in the greenwashing context. And then coming back to this issue of loss, a couple of points to make about that. I mean, there are some ways in which we've been seeing that investors have suffered a loss that can be quantified and can form the basis of a damages claim, where they've relied on the ESG credentials of an investment. And a particular example is, for example, a charity or a university who has a public position on some kind of social issue, who later finds out that their endowment fund has been invested in something contrary to this position that they've taken a public stance on. That might cause like a significant reputational damage to the charity or the university or whatever kind of sort of socially focused entity, which can then be quantified and form the basis of a damages claim. So we are seeing areas where losses can arise from greenwashing. And sort of a second area sort of following on from that, where a loss might give rise to a claim, is shareholder claims under the Financial Services and Markets Act, FSMA. So this relates to public companies who might have made a public statement about their ESG credentials or their intentions to go to net zero, whatever it may be. If they've made those representations in a certain way and it's been relied on by shareholders, if those representations turn out to be untrue, shareholders may have a claim under FSMA and can claim the sort of the loss, the difference potentially in share value that they've sustained as a result of this misrepresentation. So
just pausing there for a minute, Lucy, because I think one of the things that we've been looking at and watching quite carefully is, I think when we started off thinking initially that perhaps there would only be a loss if some sort of disaster has to occur on top of the greenwashing. So it might be there was a claim that was made that they wouldn't invest in a certain type of asset, and then it turns out that they did, and something's gone wrong and caused a disaster that's caused the share price to collapse. I think now what we're starting to see is the effect of just it being called out in some way or found out that they're not as, for example, environmentally friendly as they claim to be, that they've been engaging in labour practices that are not consistent with what the expectations were, and that in itself having an effect on the share price. So I think that's where I don't know if you want to say anything more about that, but that's an area we've been watching quite closely in terms of losses, because it was at the start it was quite hard to identify where the loss would be, but now I don't know if any of our market participants have anything to say about that as well, and from the investor side, but it seems to us that there's a more direct effect now just within the ESG issue itself.
Yeah, I'd agree with that. I don't know if that was to me or to the market participants, Janine, but yeah, I would agree with what you've just said.
I probably should pick on someone. I'm going to pick on Jan because I've known him for a long time.
Sorry, your question was too sophisticated for me, Janine. Could you rephrase it in a simpler way?
Sorry, probably just wasn't clear enough. No, what I'm really asking is, what do you think? Do you think that in itself there's a value risk within ESG and just it being found out that there's an issue rather than there having to be a loss on top of that? Do you think that that's where we are now in the market?
Sorry, you mean in terms of how ESG is perceived externally?
Yeah, how ESG is perceived and the impact of it being just discovered that there's a problem in comparison with what claims are being made in terms of if you're an investor.
Yeah. So look, if I think about the process of assessing ESG at a company, like it's important not to kind of get pulled into this kind of idea that ESG is all about big controversies, right? Because then you kind of end up chasing yourself a little bit, because then it becomes a kind of ex post analysis of, oh well, look at this big company here where these practices were exposed, and isn't that evidence of shonky due diligence by the manager? I think, look, the reality is that no due diligence process, no matter how robust, is going to uncover all the issues that are out there, right? Like mistakes happen. I think the key and where you get a lot of greenwashing concern is what is the extent of the manager's good faith efforts to do that research. And this is where I think a lot of these problems start to arise, because one way of analyzing ESG factors is to take a score from an MSCI or Sustainalytics or a major third-party provider and just say, well, look, this company is rated very highly, therefore I've done my due diligence. Isn't that it's evidence of my ESG credentials? And I think we need to kind of move past that, right? I think the problems with third-party data providers and ESG is well known, so I don't need to go through that. My view is that to do ESG analysis, you need to look at you need to look at the company, you need to look at the management team, you need to look at how they're, what they're genuinely doing, not what they're disclosing, but what they're actually implementing in practice. And there are plenty of times where, particularly in small cap companies or in value companies or in emerging markets, where the practice of sustainability can be different from the disclosure of sustainability. So that, I think, is incumbent on all fund managers who want to lay claim to integrating ESG. You need to be doing it as part of your research and process.
Yeah, no, that's really interesting. And I think that sort of touches on something that is of concern to us from the contentious side. So as Ragavan says, prevention is better than cure. And I always prefer to be involved at a stage where I can stop the contentious dispute from happening rather than afterwards. And one of the areas that we see as difficult at the moment is how are these things being tracked? As you say, how are you measuring it? And is it clear how you're going to measure it? Is it being measured in the way that investors expect? Do you have records? If there's a challenge, how are records being kept to make sure that you can show that this is what you promised to do and this is how you promised to measure it and this is what's been done and how we've fulfilled on that. And I think that is something that is perhaps a focus area as well. I mean, we've seen there was a recent there's litigation things recently brought, Lucy, was it in Germany, am I right, about an impact calculator that was being shown to investors, and but with some small print that suggested it wasn't quite as accurate or wasn't quite doing what it said on the tin. And then the question there is did they do enough to explain what they were and weren't doing and weren't measuring, and what the answers that were coming out of the calculator meant. And so yeah, I mean, I think that we've got a poll question, I think, if we could put that up, on this issue about transparency and disclosure that Jen's mentioning and how important it is. Are we able to get that up if the technology is working?
Yep.
There we are. So have a few seconds to answer this question. So yeah, really what we're interested in is that, how important is it that you have the transparency there in order to help everybody demonstrate they've done what they need to do in assessing whether they're investing in a way that they've promised to. I think, Darren, are we able to bring up the answers now? Yes, indeed. Yeah. So that bears out what you're saying, which is that what everyone is realizing now is it's important. The transparency is important from both, probably all sides of the equation, to be able to demonstrate what's been happening against what was promised. I think now perhaps if we've got some questions from our audience, and I wondered. So this is first question. It's for our, perhaps ask Adrian to deal with this one first, but we've got someone who's saying that they've recently seen government and corporate bond issues coming in at levels slightly below their non-ESG equivalents. What is your view on investor appetite for foregoing some yield in order to achieve investment targets? I think that's an interesting question, an interesting concept to think about overall. To what extent do we think investors are now willing to forego yield in order to remain high on the ESG meter, whatever we're calling that?
Yeah, it's a good question, and I think it's funny because a lot of people make out that ESG is a burden or is going to incur some kind of additional cost, which it may in some instances. You can also look at it that, in fact, if you have good best practices and you follow, and you're making improvements in your business, whether that be efficiency improvements or encouraging, in boosting morale through better working conditions and better pay conditions, or sourcing your products locally, which I must admit, with the current shipping prices and inflation, with if we had half of our businesses source their supplies locally, we'd probably be in a lot better position at the moment in the current circumstances. But there are benefits as well, I guess, is my point, to driving for these kinds of objectives. Will investors forego yield? I'm not sure. I mean, I think investors want the best of both worlds usually, and I think you're better off probably looking at what positive changes you can make to improve performance and financial performance and yield before or at the same time that you can trade off some of the expenses and capex and opex that you may have to incur to achieve those. And then it ties back to your previous question, Janine, which is about transparency. We would much rather know where the problems are and have a plan to fix them than not know and get into a pile of trouble. And it is all about transparency. If a company, and I think some of your previous comments, Janine, were related to public markets in particular, because I think there is a risk, and I won't talk about it now, but there are public companies that have suffered valuation gaps, as if you like to call it that, as a result of falling down on some of their ESG policies. But I think that as I said before, I think in the short term there is a pile of money chasing ESG type products. There will be a premium in the near term for ESG, and hopefully in the longer term it will be worth it. I don't know if that answers your question.
Could I offer a view, Janine? Actually, I think just picking up on what Adrian was talking about. So yeah, absolutely. There's a green and sustainable bonds typically trade at a tighter yield, which reflects the increased investor demand for these type of products. I think I see two problems with that. I think the first is that depending on where you buy, there is no agreed definition of what constitutes a green or sustainable bond. Different markets have different rules. Some markets have no rules at all, which is to say that a bond is green because a corporate issuer says it is green. The second problem is what ESG professionals would call additionality. There is no evidence that the green bond itself creates a positive impact that would not have been created if that bond had not been issued, which is to say that any company will have in its book of business some green projects, some not so green projects. So why not issue green bonds that fund your greener projects, allow a benefit from that lower cost of capital, and then carry on your business elsewhere with the brown assets? Are you actually ensuring that the green bond contributes an additional amount of sustainable benefit as a result of that green bond? And the answer is in many cases is not. And actually, there's a very interesting study that was done by the Bank of International Settlements, which shows that at an aggregate level, there is no correlation between the size of green bond issuance by specific issuers and the amount of decarbonization they're able to achieve. Which is another way of saying that simply issuing a lot of green bonds doesn't, at a system level, talk about your propensity, your greater propensity to decarbonize your business, which is what most people would kind of intuitively say. And that's why when we think about ESG, we think about it as being a concept that is better applied at an issuer level than at a security level. So you should be looking at the performance of the issuer itself, either it's corporate or sovereign. What are they doing in terms of their policies? And then just thinking about the securities they issue and just choosing the one that best fits your investor needs, right? Rather than trying to look at individual securities, no matter how exotically they are designed or labeled, and thinking that's going to solve your ESG problem.
Can I just add sorry, Janine, can I just add just picking up on one of Adrian's comments and kind of bringing it a little bit back to the private company field. And I think that there's certainly a value enhancement opportunity for PE in improving ESG over a portfolio's life cycle or over a portfolio asset's kind of a hold period. But as Adrian said, it's about having that transparency up front, knowing where the issues are, knowing where you may not quite be reaching that best practice. For a lot of legacy businesses that are, that haven't been created in the kind of Greta Thunberg era, there's quite a lot of, operational transformational change that needs to take place in order to adhere to the latest kind of, hot topics. So, for an investor coming in that, that knows what the exit or has a good feel for what the exit landscape will look like in 5 years, 3 to 5 years time from an ESG perspective, and has the knowledge and can share best practice around bringing that kind of experience to bear within their portfolio businesses and enhancing their kind of ESG practices, their governance practices. I think that's one of the other value opportunities that a PE investor can bring to the table for private businesses. So there's an opportunity there, and that might maybe reflect in slightly lower pricing if on the way in, if those businesses aren't quite ticking the right boxes. So yeah, that's my piece on the private company side.
Thanks very much. We're getting quite a few questions in about shareholder claims and greenwashing claims in other parts of the world, and whether we're seeing them here, and if not, why not? Lucy, I don't know if you want to say something about that.
Yeah, sure. I saw the question saying there haven't really been many greenwashing claims in the UK as opposed to other jurisdictions. And I would say I probably agree with that at the moment, that in the UK there's been perhaps more of a focus on advertising campaigns, thinking in particular of the BP Possibilities Everywhere campaign that Client Earth made a complaint about, and BP withdrew the campaign. But I think in terms of FSMA claims, there are potentially, I think, 3 reasons why the UK is at the moment potentially going to be an area where these claims could arise. And those, I would say, are firstly, there's increasing requirements on public companies at the moment to report on and disclose ESG related issues, and in particular climate related financial risk. And one might think that statistically, the more disclosures that are made, the more sort of inaccuracies there will be in some of those disclosures. Second factor is that, and this is potentially worldwide rather than the UK, but as we've discussed on this webinar, there's an increasing focus on behalf of investors and shareholders on ESG issues. And so companies should expect their sort of annual reports and other disclosures to be pored over, and claims that are made checked for their veracity. And the third thing that I would say is probably particular to the UK at the moment is the prevalence of litigation funding and claimant law firms who are able and looking to put together groups of claimants who can take claims like FSMA claims and can partner with litigation funders. So I would say those 3 aspects might lead to the UK being a sort of ideal jurisdiction for a greenwashing claim against a publicly listed company under FSMA in the sort of nearish future.
I would still probably say, and I'm sure both you, Lucy, and Janine would reflect this, that prevention is very much better than cures. So making sure you do your due diligence. And I was very heartened to hear Jen's old school approach, which kind of matches up with mine, is that you really need to look the management team in the eye. It's much better to go to the source and make sure you can all kick the tires almost on every investment opportunity. I'm sure Adrian would agree with that. The management team is so key, and the main thing you're looking for is a great exit, and that always starts with making sure that you're picking the right opportunity, DDing the opportunity correctly, and then contractually trying to mitigate any risk you may have if you identify any issues. You're putting the appropriate indemnities in place, etc. So yeah, so that was just my piece, just to make sure that that we're always focusing on making sure that we're looking at the correct metrics, drilling down into what we actually think is going to be important in driving both profitability, but kind of our ESG credentials, to make sure that we can get a great multiple on that exit that we're always shaping from the beginning.
Yes, very, very wise words, very wise words.
I try my best, Janine.
Just going back to the area where we were talking about what might go wrong, we're getting quite a few questions coming through about shareholder actions and the and causation and how to prove losses. Where that is a very difficult area in relation to shareholder actions in general. So just to sort of put it all in context, this is quite a new and developing area in the UK, and that's why perhaps we're not on the front line of these greenwashing claims that are coming in, and the issues are starting to arise. But the UK is not the first first piece, people are looking to litigate about them because there are other jurisdictions where the class action body of law itself is much better developed. In the UK, there's not much precedent. There's not been a case that's gone to trial, and there are lots of issues in general about causation and proving losses and how losses should be calculated in those kinds of claims. So we're not dodging the question. It's just a question that would have another session of an hour for itself, basically. But yes, I mean, you're right to identify that is going to be a major issue in greenwashing claims if they come through in the UK. I mean, what we're seeing, the pattern at the moment is very much the same as for other class actions, in that the jurisdictions where these actions are being taken are the jurisdictions where we would typically see class actions being taken for various structural reasons that mean that they're easier to get off the ground, essentially, in those jurisdictions without having to do too much pre-investigation and detailed work before you launch, essentially. So that's where we are on that. I mean, Adam, just picking up what you were saying about the product lifecycle, I think we have a question or an observation from the audience about that as well. So I just wondered, does anyone have any more to say about that, and how looking at the identifying in advance? I suppose from my perspective as a disputes lawyer, if we're going to say, well, it's all about the product lifecycle and we're going to look at it as a whole, but how do we identify at the outset, and how and where do we identify at the outset exactly what you're going to do and how that works? So that was a question for Adam.
Sure. So I guess from a, I'll take the term kind of product life cycle as in kind of, again, kind of more of a kind of diligence point. How do you assess? And that I can see there's another question on B Corp and other frameworks that can be used to accreditate a business. And I think that there's accreditations give a nice kind of easy pass, I think, for investors, because a lot of the due diligence heavy lifting has been done by a third party anyway. And so I think if you are a business that is looking to demonstrate ESG credentials to the extent that you can accreditate as much as you can, that's probably a good use of time, and it tends to be helpful for investors. I'm just looking at the question again. The detail of metrics at product lifecycle level to avoid greenwashing. It's again, as well as B Corp, there are a number of other some more macro I guess accreditation measures that businesses started to use. So there's the sustainability principles and objectives framework, which is kind of arisen from Silicon Valley, which is kind of a B Corp for more kind of established late stage businesses that are looking to list. The challenge with a lot of these kind of frameworks is that they are being created by companies themselves. So there's a bit of kind of self-governance there, kind of ingrained in those. So that's a kind of field that's still kind of developing. Coming back to diligence point, accreditations help, but really it goes back to what's been said before around seeing management face to face, really digging into do they believe it themselves? Ultimately, it's very easy to say, yes, we want to be more sustainable, yes, we've got these objectives, but does the CEO believe it? Do his board believe it? Are they bought into it, or are they just doing it because they have to? I think that you probably find that on average it's probably more of the latter than the former. I think a lot of people have still yet to buy into the benefits of ESG and purpose as a driver of profit, which is understandable. It's a relatively new movement, and so it's about attacking that diligence from a number of angles.
Thanks. I can see Adrian's scan.
Yeah, I think just picking up on a couple of things Adam said there, I think there are other standards, whether it's ISO quality standards or FSC if you're in forestry or what have you, and those do help. And actually, when I start out due diligence, I look not only for the latest certificate, but also, are they up to date? Quite often companies will get it once and then don't renew it. So you really need to watch out for that. Warranties as well is another great area to look. Do they provide warranties on the product? Are they setting aside provisions against those warranties in case something goes wrong? Very, very, very important area to check. But just in terms of cradle to grave and product life cycle, I think it is a really great question because, and I think this is probably a growing trend, but we've seen a number of opportunities recently where you know, there are businesses being built around that product life cycle piece, and quite often in the recycling element. You know, there is value in waste. There is value in recycling and reusing and repurposing product. And it goes for, you know, everything from tires, which are very difficult to get rid of, to, you know, organic waste, to food waste, you name it. And I see more and more business models actually being created around that full product life cycle value proposition. I know that doesn't answer the question. The question was more specifically, you know, do ESG principles look at the full product life cycle? And I think in some industries, they're actually very strict. In automotive, I know because I used to work in automotive, they do absolutely look at, you know, everything from manufacturing all the way through to when this goes into a car crusher, you know, what bits of it can we take off and recycle, and everything from the foam to the plastic that's used is analyzed and validated in terms of recyclability. So in some industries, I guess my point is better than others.
Yeah, and then particularly in the consumer product space, you know, you're seeing the rise of closed loop packaging and closed loop processes where, you're right, Adrian, it's that entire life cycle. So you know, customers using the product, you know, sending let's say it's a bottle product, sending the bottles back to be refilled and, you know, being delivered. There's a lot of logistics involved around, you know, circular economy and closed loop, which you know, goes to that point around, you know, financials following the, you know, doing the right thing. You know, it's very difficult to get that full product life cycle right in a profitable way at the moment. So I think that's a challenge that will you know, an area that will keep developing over years. Yeah. But I think it goes to, you know, businesses doing the right thing first and then letting the economics kind of follow.
Yeah. Hopefully Amazon will do something about their cardboard consumption.
I know.
Well, thanks everyone. I think we're running out of time, and I'm not going to get to all the questions. But I can see that there's a theme coming through, which is people are concerned about how to measure, what the metrics are going to be, how we're going to do it, which data is the right data to use to demonstrate it. I mean, that's a concern that I share, and it's one of my key concerns over the last couple of years about all of this, is whether it's got to be thought through at the outset. So if we're talking about people who they know they need to demonstrate ESG credentials, and we know it's vague, and we've discussed, you know, that's an issue. But have they bought into it? And if they haven't, you know, if they haven't bought into it, then I think there are concerns about whether they're properly measuring it. And from a dispute avoidance perspective, I think the big message from Lucy and I would be: make sure it's clear, make sure you're clear at the outset what you're doing, what you're going to do, how you're going to measure it, and that you keep the records and do the work to make sure that if there's a challenge, that you can say, well, this is what I said I was going to do, this is how I said I was going to measure it, and this is what the answer is. So I think that's the big message from Disputes, Ragavan. I don't know if have you anything you want to say to finish us off on from your
No, I'd just like to thank Adrian, Adam and Jen. Yeah, I think it's been a really interesting discussion. Yeah, so thank you for your time. It's been the deployment of capital efficiently. There doesn't need to be a tension between that and ESG principles, but we're here to assist you get it right from the outset. So yes, I think that's all for us. Thanks for everyone, and yeah, look forward to speaking to you all soon.